after studying this module, you shall be able to know the meaning of working capital, identify the need of working capital, understand the various factors affecting working capital, analyze the working capital cycle. Let's begin with the introduction. Working capital management is the functional area of finance which covers all the current accounts of the firm. It is concerned with the management of the levels of individual current assets as well as current liabilities. It refers to the funds invested in current assets which are essential to use fixed assets profitably. The classification of working capital may be done on the basis of components of working capital, also on the basis of the time factor. Considering components, the working capital may be of two types: gross working capital and net working capital. Now, the gross working capital refers to investment made in all the assets together. The benefit on account of trade payables are not taken into account. Net working capital, it refers to excess of total current assets over total current liabilities. The working capital requirements on the basis of time factor involved may be of two types: permanent working capital and temporary working capital. The permanent working capital is the maximum level of investment in all the current assets at all times, and the temporary working capital is that part of working capital over and above the permanent working capital, and it keeps on fluctuating. Now, working capital is the amount of investment made by the firm in its current assets to be able to run the business smoothly. A business does not run by merely investing in large machineries purchased in big buildings. It also needs to invest in raw material which it proposes to process through its machineries. The output that produces requires time to be brought to the market to be sold, and finally the buyer also takes time in making payments. Funds are required till this entire cycle is complete, and since it is ongoing process, these funds remain invested in the business till it is a going concern. A large part of these funds have to be provided by the owner or borrowings from banks, but a small part of it also comes from the credit extended by the suppliers of raw materials or other components of current liabilities. Let's focus on the importance of working capital. Working capital is very important aspect in the successful running of the business. State of the art technology will not be able to produce good financial results if it is not coupled with the proper working capital management. The funds should be carefully handled in managing the day-to-day financial requirements of the firm. Having larger funds to provide for all kind of requirements and all kinds of emergencies is not a very good idea. A little bit of risk is also necessary in business to be profitable. A low level of working capital is not a good business proposition either, as this would mean struggling to meet the day-to-day expenses and not being able to make payments to the business creditors on time. Therefore, working capital should not be too large, as it implies idle funds or overcapitalization, which means low rate of return, nor it should be so less that companies are unable to meet its liabilities and it runs the risk of solvency. What therefore should be the optimum working capital and how it is determined is an important question which needs to be well answered. One of the ways is to calculate the current ratio, which is given by the current assets divided by current liabilities. It is a reflection of working capital management. Current ratio, which is ideally 2, and asset test ratio, which is 1, is generally considered as adequate working capital. However, it may vary from industry to industry. Now let's begin with the working capital cycle. Now the working capital cycle is also known as operating cycle. It helps in ascertaining the duration for which funds are required for various stages of the working capital cycle. It refers to the length of time between the firms paying cash for materials, etc., entering into production process, and inflow of cash from debtors. This cycle starts with cash, with which the firm buys raw material to process and to convert it into finished stock by bestowing efforts on it. As you can see on the diagram, that the working capital cycle is beginning with the cash. We are converting cash into raw materials, then to work into progress, then finished goods, and then finally into debtors. The determination of working capital cycle helps in the forecast, control, and management of working capital. Working capital cycle can be calculated in two ways. The first being a simple operating cycle and the other being a weighted operating cycle. Now let's begin with the simple operating cycle first. The simple operating cycle is when we add up the number of days it takes to complete the cycle. For example, XYZ Limited has obtained the following data concerning the average working capital cycle for company. The data is raw material stock turnover 20 days, credit received from suppliers 40 days, work in progress turnover 15 days, finished goods stock turnover 40 days, debtors collection period 60 days. Now the total of all, and if we will deduct the credit received from the suppliers, the total comes 95 days. Thus, in this case, the working capital operating cycle is for 95 days. Now the next, weighted operating cycle. Weighted operating cycle is an extension of the concept of working capital cycle and helps in estimation of the amount of funds that are required for various stages of the cycle. Under this method, appropriate weights are attached to the duration of various stages of the operating cycle, and the weighted duration is added to arrive at the weighted operating cycle. The weights are the ratio of the funds per unit required at each stage to the selling price per unit. The weighted operating cycle multiplied by the sales per day gives the working capital requirement. A certain amount of cash required to be kept may be added to this figure. Suppose in the above illustration, the cost of raw material is rupees 5, work in progress is rupees 7.5, finished goods cost rupees 10, and the selling price is rupees 15. Then the weights given to the raw material stage would be 0.33, work in progress would be 0.5, finished goods will be 0.66, and debtors would be 1. Now, weighted operating cycle is given by D multiplied by W. It will be summation of each component of working capital. Raw material stock turnover 20 days, credit received from suppliers 40 days, work in progress turnover 15 days, finished goods stock turnover 40 days, debtor collection period 60 days. The weighted operating cycle may be calculated in the following manner: 0.33 multiplied by 20 plus 0.5 multiplied by 15 plus 0.66 multiplied by 40 plus 1 multiplied by 60 minus 0.33 multiplied by 40. The total comes 87.5 days. Let's come to the factors for working capital. The following factors should be taken into consideration while determining the requirements of working capital. Number 1, production policies. The need for working capital will vary according to the production plans. In some cases, raw material can be procured in one season and used throughout the year, whereas in other cases, production cycle is limited to a part of year and raw material accumulated throughout the year. Number 2 factor, nature of the business. The shorter the manufacturing process, the lower is the requirement for working capital. If the manufacturing process is longer, the requirement of working capital will be higher. Credit policy, number 3, where liberal credit policy is followed, higher working capital is required as large amount of funds are tied up in sundry debtors. Similarly, if a company enjoys good reputation in the market, it can get raw material on credit and will require less working capital. Number 4, inventory policy. If inventory is efficiently managed, less working capital is required. However, if inventory is not properly managed, more than required purchases are made, large amount of working capital will be required. If the raw material is available throughout the year at constant prices, inventory can be planned and less amount of working capital will be required. But if supply in the market is erratic, large inventory may have to be purchased at times, building up huge piles of inventory and thereby more working capital. Number 5, abnormal factors. Factors, for example, strikes, lockouts require more working capital. In recessionary conditions, higher amount of finished goods remain in stock. Similarly, if there is inflation in the economy, more amount of working capital will be required for maintaining the same amount of current assets. Number 6, market condition. Market conditions also play important role in determining the working capital requirement. If competition is tough, the firm will have to give liberal credit to its customers and therefore investment in debtors will cause an increase in working capital. Stock of finished goods must be ready in the stores to be able to serve the customer as and when he demands the products. The customer will not wait in competitive market and the competitors will not leave any stone unturned to snatch away the firm's loyal customers. Therefore, it becomes a necessity to provide quick services. Number 7, conditions of supply. If supply of raw material etc. is prompt and nearby, small investment in raw material will be needed. If supply is erratic, availability is for a short period only, then the firm has to keep large amount of raw material as stock, increasing the requirement of working capital. Number 8 factor, inventory policy. Seasonal and cyclical changes in production and sales affect the working capital. Number 9, growth and expansion. With growth and expansion, more working capital is required. If a firm is growing, even the permanent working capital will increase with time and will fluctuate. Number 10, level of taxes. With higher tax rates and requirements to pay taxes in advance, more working capital is required. If the government demands more taxes or in advance, then more funds will be blocked in running the business and higher working capital will be required. Number 11th factor, dividend policy. Dividend policies also affect working capital requirements. Number 12, price level changes. If prices are inflationary, more and more working capital will be required. But if prices are reducing, the investment in working capital will reduce with time as prices go down. Number 13, operating efficiency. A firm which has good operational efficiency can manage effectively with less working capital, whereas a poor management will require large working capital. Now the next topic will be working capital management, how we can manage the working capital. Now it is an attempt to decide the optimum level of the various components of working capital management in tune with the risk return profile acceptable to the management. It means number 1, determining the need for working capital. Number 2, finding the optimum level of investment in different current assets. Number 3, examining the salient points of each element of working capital. On same level of production, if working capital is more, the returns would be less, and if working capital is less, the chance of not being able to meet its short-term liabilities increases. This is assuming risk in the business. Thus, working capital management is striking a balance between risk and profitability. Working capital should neither be unnecessarily higher and neither low. High working capital indicates losing profits by not investing excess capital in other investing opportunities, and low working capital means taking the risk of not meeting business obligations and risking business reputation or goodwill. However, a surplus is not as bad as deficit. A shortfall in working capital may wipe out the firm from business. Another important aspect is to balance different components of working capital. A high current ratio does not indicate satisfactory working capital if large amount is blocked in inventory, or rather slow moving and obsolete inventory. If debtors are very high and old, it does not reflect good working capital but poor collection policy. Large amount of idle cash also does not give good returns. Let's discuss components of working capital. Working capital management also means managing each and every component of working capital. Different components of current assets require fund depending upon their respective operating cycle and the cost involved. The current liabilities provide financing depending upon the lag in the payment. The various components of working capital can broadly be classified as current assets. Examples of current assets are cash and bank balance, inventories, inventory of raw material, inventory of work in progress, receivables, etc. Examples of current liabilities are creditors for purchases and creditors for expenses. Management of components of working capital. The above components of working capital are required to be managed separately and also collectively. Cash management. The efficient collection and payment of cash is the function of the Treasury Department. If cash is properly managed, an important portion of the working capital will be managed. Inventories management. Inventories are important current assets of the firm. They require certain investment. The funds of the organization are blocked in inventories. Therefore, losing interest on these funds becomes the opportunity cost of holding inventories. They should be so managed that neither large funds are blocked nor there is any risk of being stock out. Receivables management. The goods are not always sold on cash. They are also sold on credit. It takes some time to realize this cash from customers depending upon the credit allowed to them. Receivables include debtors and bills. Firms offer credit to a customer for a number of reasons, but the ultimate objective is to maximize the returns on investment in receivables and minimize the risk of bad debts. The financial manager should follow such policy through which cash resources of the firm can be fully utilized. Management of receivable creates a trade-off between liquidity and profitability. Thus, the ultimate objective of receivable management is to maximize the sales so as to maximize the profit. Current liabilities. The time allowed by the suppliers to make payment is current liabilities. Trade credit should be fully utilized, but at the same time cost of trade credit should also be compared. Creditors for expenses. Creditors for expenses arise when there is delay in making payments to the workers for their wages and other trade expenses that create outstanding liabilities. This benefit in lag of payments provides small but meaningful source of working capital. There are some graded illustrations. Let's begin with the illustration number 13.1. Consider the following information of XYZ Limited. There are two columns. On the first column, information, the particulars are given. In the second column, amount is there. The first is raw material inventory consumed during the year, which is rupees 6 lakhs. Average stock of raw material rupees 50,000. Work in progress inventory rupees 5 lakhs. Average stock in progress inventory rupees 30,000. Finished goods inventory rupees 8 lakhs. Average finished stock held rupees 40,000. Average collection period from debtors 45 days. Average credit period availed 30 days. Number of days in a year 360 days. You are required to calculate net operating cycle period. Number of operating cycles in a year. The solution is as follows. Raw material holding period will be average stock of raw material multiply the number of days, and the total raw material requirements is 6 lakhs. Work in progress requirements total is rupees 5 lakhs and the total number of days 22. Finished goods holding period is 18 days. Average collection period from debtors is 45 days, which is given in the question itself. Gross operating cycle is 115 days, the total of all. Creditors payment period is 30. After deducting the creditor's payment period 30, we will get net operating cycle period, which is 85 days. And the number of operating cycle in a year, the total number of days in a year divided by the net operating cycle period, which is 4.24 cycles in a year. Illustration number 13.2. The following information is available in regarding operating cycle for each of the 2 years in respect of Vishnu Limited. Raw material stock turnover for year 1 it's 27 days, for year 2 24 days. Work in progress turnover year 1 20 days, year 2 25 days. Finished goods stock turnover year 1 22 days, year 2 19 days. Debtors collection period for year 1 25 days, for year 2 35 days. And the gross operating cycle comes 94 days and 103 days. Credit received from the suppliers 21 days and 19 days. So, the net operating cycle will come 73 days and 84 days. Using the above data, answer the following. Number 1, what is the percentage change in number of operating cycles? Number 2, what is the percentage change in length of operating cycle? Number 3, explain the reason for such increase. Here is the solution. Percentage change in the number of operating cycles. Here we are taking the number of days in a year 365. So the number of operating cycle for year 1 will be 365 divided by 73, which comes 5 cycles. Similarly, number of operating cycle for year 2 will be 365 divided by 84, which comes 4.35 cycles. Percentage decrease in number of operating cycles between year 1 and year 2 will be 5 minus 4.35 multiplied by 100 divided by 5 is equals to 13%. Now, the percentage increase in length of operating cycle. Percentage increase in operating cycle will be 84 minus 73 multiplied by 100 divided by 73, which comes 15.1%. Number 3, reasons for increase in operating cycle. The reasons are work in progress conversion period has increased by 5 days, debtors taking longer period to pay, which is 10 days, creditors demanding the payments early, which is 2 days, and reduction in raw material storage period, which is 17, reduction in finished goods storage period, which is 3, and finally the net increase in operating cycle is 11 days. It is important to note that there exists inverse relationship between length and the number of operating cycle. Summary. Now, let us summarize the whole information. Working capital management is the functional area of finance which covers all the current accounts of the firm. It is concerned with management of the level of individual current assets as well as current liabilities, and therefore it is the management of total working capital. Working capital can be gross working capital and net working capital, or permanent working capital and temporary working capital. Working capital is a very important aspect in the successful running of the business. The operating cycle helps in ascertaining the duration for which funds are required for various stages of the working capital cycle. When we add up the number of days it takes to complete the cycle, it is called as simple operating cycle. When weights are considered, it becomes weighted operating cycle. The working capital is affected by various factors, for example, production policies, nature of the business, credit policy, inventory policy, abnormal factors, market conditions, conditions of supply, etc. Working capital management is striking a balance between risk and profitability. Working capital should neither be unnecessarily high and neither low. Working capital management also means managing each component of working capital.